Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. My name is Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Jason Faucett of Transition Capital Partners, TCP. Max, what was the takeaway you had from our conversation with Jason?
I found the episode to be really fascinating. Jason and Transition Capital Partners have been around for a long time in Dallas. TCP has actually been around 33 years, and they've acquired over 50 platforms during that time. So Jason shared some data with us related to hold period and related to returns, which we always are interested in. But just that long track record and the vast amount of deals that they've done, it just gives us such a glimpse into the space of what's possible. And actually, Jason mentioned that the average hold period for their deals has been 4.7 years, so almost 5 years, which is what we usually see in most of the LBO models and the pro formas. So that was well aligned. Although he said, there's going to be outliers where they have to hold on a bit longer sometimes, but he did highlight velocity of capital as being extremely important to himself and to TCP. And really, I think it's important to the independent sponsor model. Jason highlights that his job is really to take wins when they're there and return capital to the LP investors, and then let the LP investors decide when's the right time to invest again, or if Jason and TCP are the right people to invest with. So I love that perspective. I love the thought of, you just have to take it while it's there sometimes. And there's a risk in not taking the win. And Jason gets into that a little bit as well. So it's a great perspective on a long track record of independent sponsor investing. And there's so much more that he covers that I'll let you guys and him talk about. But it was just a really fascinating episode.
Well, I'm going to piggyback on your point there, Max. That was really what grabbed me in the conversation. His kind of definition of what they do as independent sponsors, which I think is probably a pretty fair generalized definition, which is this idea of, velocity of capital. They are in the business of transactions. Their job is to raise, deploy capital into businesses, grow those businesses, and then turn around, sell those businesses, and return the capital, hopefully a larger pool of capital to the same LPs, and to rinse and repeat that. He says, we are not empire builders. We are not trying to grow indefinitely large businesses here. And this, while this might sound self-evident to some people listening, just a reminder, as we talk about in the episode, in the interview, that there are a lot of independent sponsors, at least that we interview, that talk about long-term hold, patient capital, permanent capital, evergreen. And so you definitely, there's a trend or cohort of independent sponsors who don't think the way that Jason and TCP do. So it just, as I said, it really grabbed me how stark and sort of decisive he was about what their role is as independent sponsors. Nicholas, what about you? What was the takeaway from our conversation with Jason?
I suspect the name Transition Capital Partners was used in order to signify that these guys can help founders or sellers transition their business to a new, strong steward. Now, one of the aspects of this conversation I enjoyed the most was actually Jason talking about transitioning internally at TCP. And he talks about how he and his two current senior partners are the fourth generation of owners of TCP, or senior partners, if you will. And I think this is a fascinating take. Most independent sponsors aren't old enough or mature enough, if you will, that they've gotten even to the second generation. Most wouldn't know how to transition your company from your own hands to your associates when that time comes. But Jason walks us through why they've done it this way, how they do it, and they really embrace the deal-by-deal model of the independent sponsor space to facilitate this. He also says that TCP there is no brand value without the senior partners putting in the work, and the economics should reflect that. And I think there is some truth to that, even for TCP that is more than 30 years old. So I thought that was educational and something that a lot of people should aspire to learn from, because I think a lot of independent sponsors are focused, rightfully so, on their operating companies and portcos and on the next deal or next exit. There isn't as much attention going into the fund level dynamics or long-term sustainability and scalability of what you're building at the fund level. I think much less attention is going there than, for instance, for normal conventional funds. But I do think as these shops grow older, we will see more and more professionalization around this. And I think there is a space that TCP is pioneering how to do it. So it's cool to learn about that.
Yeah, agreed. And the fact that they've not done it once, but 3 times, a 4th generation of partners. This is an investment firm, an independent sponsor that goes back to the 90s. So in a very, very rare handful of independent sponsor firms that are that old and that can claim so much continuity. Well, before we get to the interview with Jason, a reminder that Minds Capital invests equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average about 1 commitment per month. So if you are a sponsor raising equity for a platform acquisition, submit your deal to us at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form on our website for accredited investors. If you are an accredited investor, you can fill that form out to be kept in the loop on future raises. That is at mindscapital.co. Okay, here is the Minds Capital podcast interview with Jason Faucett of TCP. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Based in Dallas, Jason Faucett is a managing director at Transition Capital Partners, TCP. TCP is a 33-year-old independent sponsor firm, and Jason joined as an analyst in 2009. Together with his 2 partners, Andy and Keith, he bought out the original founder in 2021. Jason views himself as a steward of the TCP brand, focusing on doing the right things in business and for investors so that the company can eventually pass again on to the next generation of partners. Welcome to the Minds Capital Podcast, Jason Faucett.
Yeah, thanks. Great to be here. Looking forward to it. Nicholas, it's a long time in the making. So glad we're finally getting this out of the way.
So, Jason, through those 33 years, TCP has gone through multiple iterations, multiple versions. You said today is sort of 4.0. Take us through 1, 2, and 3 as well.
Yeah, it's I think the thing that I think I'm most proud of with TCP is the history. We've been part of this community for a long time. Our founding partner, Dan Patterson, started the group in 1993, along with a couple of partners. When something survives 33 years, it goes through multiple iterations, and yet the brand has always survived. And because of that, Dan's considered one of the old godfathers of Dallas private equity. He was here doing this when there wasn't much private equity or finance in the city. And now, if you look around, in 2026, this is the second largest financial hub in the country now. So we take a lot of pride in being part of that history, in being here through that evolution. So quick history, Dan and his partners, Mike and Paul, started the strategy in 93. Dan was a successful entrepreneur before that. They stood up TCP. They had a really great run together for 12 years or so. Eventually, Mike and Paul left and started competing funds. And the second generation of partners, Kevin and Rick, joined Dan as partners. They brought several of us together with them from operating companies that they had run in their past. I was one of the analysts on the second generation of TCP. Then as Kevin and Rick eventually left the partnership to, again, start another fund, start another strategy. We became, I was a director in 3.0, and now I'm a partner in 4.0. Dan retired from the partnership 4 years ago, and we bought the business from him, if you will. It was important to me, and I think important to Dan, that the brand continue on, and that we keep doing deals in the city, and we did that. And it was a great process with Dan. Dan is still an anchor investor of ours. His CFO is one of my best friends. So there's a very close relationship with Dan's family office and the TCP brand. And here we are, 33 years later. I've been here 16 years at this level now, 16 or 17 years. I worked for a portfolio company before that. So this is really all I've ever done, minus a 4-year hiatus in between the portfolio company and TCP. So, proud and happy to be standing here talking to you guys. So.
Well, Jason, over that long history and through the various players, as you had told us in the pre-call, a lot has actually stayed the same. The strategy hasn't changed too much, and the geographic focus hasn't either, right? Could you respond to that?
Yeah, I think that's very accurate. Something that we're very disciplined about, very proud of. That, in many ways, we're doing exactly what Dan was doing 33 years ago. This is a pretty typical lower middle market buyout strategy. And if we're being honest, there's not a lot of differentiation from shop to shop. You can talk about the size of deals you do and some industries you focus on, but we all kind of do the same thing. The differentiation is really the personality and the experience of the people running the deals. What interests us? What do we want to do? Where do we want to invest? So when we think of what we do today, the deals have gotten a little bit bigger. The market has evolved. There's more capital available to the independent sponsor channel, so we're allowed to do bigger deals than Dan could do 30 years ago. But it's still the same lower middle market, 3 to 20 of EBITDA. We focus on a couple of verticals, like services, very broadly defined, in niche manufacturing. When we think of things that make us a little bit unique, or at least make us us, it starts with a pretty maniacal focus on Texas. We all feel like we're blessed to be here right now in this ever expanding market, the Texas miracle, if you will. We're all happy to be here because there's so much activity going on in our backyard. And this is a market that we know, that we understand, that we believe in, and that we love the people here. We have this rule, this birds of a feather rule, that if we're investing with people that are either from this part of the country or chose to be in this part of the country, then there's a high probability that we're probably going to share a lot of characteristics, a lot of interests, morals, principles, including how to run a business, how to treat people. So we've always believed that if you invest with people that you genuinely like and want to be around every day and actually have some shared interest, then when the bad times come, and they will, in every investment with every company, you're going to have challenging times. If you actually liked each other every day and believed in each other and supported each other, when those bad times come, you're going to have a higher probability of getting through them. And that's been a core thesis of ours for many years, is take advantage of the home court we have. There's so many private equity groups all over the country that spend a lot of time and resources trying to do more deals in Texas. We can step out our front door and do that. And we get to jump in the truck and drive to our companies. We get to be there more often because they're closer. And, if you put that thread a little bit longer, we have a little bit of influence in these markets. Our LPs have even more influence in these markets. So if there's any chance that we can bend the universe for one of our companies, it's going to be here. So every chance we get, we want to do a deal in Texas and surrounding states. When we do go other places, and we do, it's because an intermediary that we know, that knows us, says, hey, this is something you should go look at. or it's a direct deal where we have an angle. We own a company in Denver right now. That's a great company, and we love Denver. But we also love the ones in Houston and Austin and Port Arthur and Dallas, because they're just easier to get to and help whenever we can. So we don't try to be all things to all people. We're just a small 6-man team in Texas. There's thousands and thousands of private equity groups all over the country. I'm trying to spend my time and my energy in places where we can actually win a tie. And that's here, so we try to stay as focused and disciplined about that as we can.
That longevity usually, one hopes, means a strong brand, a brand that's had 33 years to build. And with the strong brand, particularly in this world where sometimes differentiation from one shop to another is hard to argue, and there are for good businesses, there's a lot of competition, as we all know. You'd hope that a strong brand would have flywheel effects, would help you differentiate yourselves, would maybe get you earlier looks at deals. Maybe the seller knows who you are, knows the TCP brand, and on and on and on. How much is brand a kind of value that a true economic differentiator for the firm?
Yeah, we think it is. There's a reason why I think it's been important over all these years for the next generation of partners to stay with the brand versus starting their own. And as you often see, we believe the brand matters as much as possible. Look, if you're a business owner in Texas or Oklahoma City or New Orleans, there's a chance you might know TCP. But there's a really high chance that your accountant and your investment banker and other business relationships in the region would know TCP. And one of the things I tell sellers, as we've had a couple conversations, we decided there's some interest there. The first thing I tell them is call everyone you know in Dallas. We've been doing the exact same thing in the same place for 33 years. There's nowhere to hide in this town. This is the biggest small town on the planet. Everyone knows each other. So if you're in this part of the country and you have contacts in Dallas, there's a high probability you're going to find someone that knows us, maybe has been in business with us, at least knows us in the community. And I'll take my chances that the majority of those people are going to have good things to say about us. And if I can get to that level of trust with a seller, if they can check me out through their network, then we cover a lot of ground. And again, that to me is the differentiator. The brand, 33 years, 50 plus deals. There's a lot of people that are familiar with this. And just as importantly, you're going to find people that are familiar with the partners, the people that are actually running the deal and driving the shop, because ultimately that's who you're doing the business. You're doing the deal with. You're not doing the deal with TCP. You're doing the deal with Jason or with Andy. So we have found that to be very valuable. We believe it's going to be even more valuable in the future. Again, as our world has just gotten so competitive and so noisy, we believe that to get deals done in the future, it's going to be scrappier. It's going to be more direct deals, more buy-side deals, more sellers and companies that may or may not be, probably aren't running a full process. So we need to find deals that are out of our network, and or lightly shopped. Maybe they're considering it, maybe they're not. And maybe, just maybe, that personal connectivity with us, the ability to build a relationship with us over months instead of weeks in a traditional process, can be the reason that we get a deal done. And then on the flip side of that, once you get the deal done, that time we've spent together, getting to know each other, learning to trust each other, checking each other out, we think it's just a stronger foundation of a partnership going forward.
Jason, I heard you say 50 deals. Does that mean 50 platform acquisitions over these 33 years?
50 plus platform acquisitions. I think the number is 55 now, plus some add-ons. This company has averaged about a deal and a half a year in terms of new platform acquisitions over a 33-year period. And it's been pretty consistent. On a great year, you do two. And on a slow year, occasionally you don't get one done. But for the most part, it's been pretty consistent, at least for the 16 plus years that I've been here.
You just mentioned there, Jason, that you think in the future more and more deals will be done proprietarily or buy side. Why is it that you think the intermediary step might change or evolve on a go-forward basis?
Yeah, it's a bit of a hunch, but look, we've bought a lot of businesses from investment bankers because of the history. We have been allowed to be, we've probably been more competitive in well-banked processes than most independent sponsors, but we still don't have a very high batting average in those processes. The funds are hard to beat when they're convicted about something. With the continued growth of the space, and then especially the growth of the independent sponsor space, the family offices that are doing more direct deals. Again, it's just a much more competitive space than it used to be, Nicholas. And so we as a partnership, we're trying to be realistic about that and objective, and think about what the highest probability of success for us. And we think that it's going to be an even deeper focus into our networks, uncovering direct deals, deploying buy-side intermediaries, and just expecting that we're going to have even a lower batting average in the future with the more sophisticated banked processes, because there's just going to be more people chasing those deals. So I don't know if I'm right or wrong, but that's what we're preparing for.
No, I like that. So you're saying that, or what I'm hearing is that 10 or 20 or 30 years ago, TCP could participate in auctions and bankered processes and have a certain win rate, but because of competition, that win rate is coming down. And so in order to maintain the one deal a year cadence that you've had, or slightly higher actually, you have to then seek other channels for deal sourcing.
I think that's directionally accurate. I think the way that I would say it is that 30 years ago, I think Dan would say that there were just less sophisticated intermediaries available to the lower middle market. So if you had a $5 million EBITDA business in Texas 30 years ago, there wasn't a significantly sophisticated investment banker shopping that deal. It was a less sophisticated process. It was more of a local process. Now, as the market has become infinitely more efficient, and the really good investment banks have built teams that can come down market, and the boutique banks investment banks have proliferated. I just think you're seeing more and more sophisticated processes around these smaller assets. And you're also seeing much larger funds come down market. One of the things that we've heard a lot over the last 12 months, and we've kind of felt it in the market, is that you have $300, $400, $500 million funds. Because their bigger competitors are coming into their space, those funds are now coming into our space. Now you have $400 million funds that are willing to do a $2 or $3 million EBITDA business that they wouldn't have touched several years ago. Now they'll do it, and they'll immediately deploy a pretty aggressive add-on buy and build strategy. That's just behavior that we didn't see a lot of from the middle market funds, several years ago, and now we are. So again, we're having to adapt as, again, our world's just getting more competitive.
In order to sustain for 33 years across 4 seasons of partners and 55 platforms, I think it's fair to say there must have been a certain amount of success along the way here in order to sustain all of that and keep attracting deals and investment partners. Can you give us a little sense of what that actually means for an independent sponsor who has this kind of longevity? Like, what does it mean financially and recruiting wise, access to talent and capital partners? Well, what does it actually mean to be a successful sponsor over the long term, like you've been?
It's a great question, and especially with, again, the growth of the independent sponsor space and so many new independent sponsors evolving, especially out of this town. Dallas is the epicenter of this activity.
Yep.
I've had this conversation a lot. People ask me, how do you do it for 33 years? And I think there's a couple of answers. Number one, we've made a lot more good decisions than bad. That's always the start of it. Dan told me a long time ago, he's like, if you're allowed to do this for 30 years, and he was speaking of himself personally and me personally, by definition, that means you made a lot of good decisions because people kept giving you money.
Exactly.
Because the industry will eventually wash you out, right? If you don't. Now, that's not to say we haven't had bad outcomes. You don't go 33 years and bat 1,000 in this business. I'm 47 years old. I've been a part of a couple of them already. Some of the things I'm most proud of, though, are that our investors, even after bad outcomes, give us money. They trust us again. And I think the requirement there is to own your mistakes and just call the balls and strikes. When you have a bad outcome, you got to go sit down with your LPs and you got to explain exactly why. And I promise you, if you have one turn negative, and especially if they go to zero, you can blame market forces and things and there's a bunch of things that are out of your control that I promise you helped. But ultimately, I guarantee you can drill it down to 2 or 3 things that were direct consequences of decisions you made as a board member, as a chairman, that you were just wrong about, that you missed on. And you got to own that. And you can't shy away from it because you got to learn from it. If you're not willing to go through that cathartic exercise of saying it out loud and owning the responsibility, you're not going to learn from it. And this business is no different than every other aspect of life. You learn a little bit when you have success. You learn a lot when you don't. So we've always taken that responsibility very seriously. And that also comes from the history of how we got here. Our business is a little bit different than the average independent sponsor that starts today, because today there's an entire industry of institutional investors that will invest in an independent sponsor deal. That didn't exist when I got in this business. It sure didn't exist when Dan started 33 years ago. That's really a phenomenon that has evolved over the last 8 or 10 years. So we built this business passing the hat locally with a group of local investors, some family offices, a bunch of high net worth guys that we just collected over the years. Guys that over the years we got introduced to, they wanted exposure to private equity deals. We let them in and they've just stuck with us over the years. And some people come and go, some people age out. But for the most part, our LP base is pretty much the exact same as it was 10 years ago. These are the guys that Andy and I have developed. Most of the guys that we inherited from Dan are have aged out naturally. So the majority of our LPs are local. These are people that we know in the community. Again, I told you earlier, Dallas is a small town. Everyone knows each other. The finance community is very small. All these people invest with each other. They're in different deals together. They know who are their friends invest with. It's a really fun community to be a part of. And we've been blessed to be kind of a fixture in that community for a long time. And it's really fun to make money with your friends, right? You get an attaboy, they buy you a beer. That's a blast. It's a lot of responsibility when you have a bad outcome and they're your friends. Because now you got to go have a coffee with people that you see every day that you've known for decades, and you got to own that responsibility. We've taken that really seriously. We've never shied away from it. We've always enjoyed the personal accountability of investors that we know, local investors that were in our deals. It's not for everybody. I don't know if I'd build the business that same way if I started it today, but that's the business that we built. So now, even as we go do bigger deals and we have bigger institutional partners in the deals, we're still always going to have a bucket of our core local LPs that are always going to be in every deal if they want to be, because they supported us when other people wouldn't give guys like us money. So, again, you do the same thing in the same place for 33 years. It's the same people giving you money, so you have to perform. And 2, when you don't, you just got to go own it and again, learn from your mistakes.
If you were to generalize across a portfolio of 55 deals to date, what are some of the patterns that you're seeing in terms of how long you tend to hold these, maybe how many of them exceed base case, how many of them perform below the base case projection from the onset, how much rollover equity do you do, what's the multiple you've paid, has this evolved over time, and what are the outcomes that they kind of ballpark are fairly typical without kind of digging into the outliers maybe?
Yeah. So, it's 30 years of data, the data set kind of starts to matter. You start to have some statistical data. Things that jump out to me that in terms of pattern, you mentioned hold period. That's an interesting one because I think we have the same pitch that every independent sponsor has. Like, hey, we're patient capital. We don't have a fundraising cycle. We're not going to come to you in 5 years and say we need to sell you to put a win on the wall. No. And I mean that when I say it. And we are patient. Our LPs are very patient with us. And we've held deals longer than 12 years in my career. But we've also sold deals in less than 18 months, 3 times. So sometimes you get the thesis right, you get the people right, and the universe kind of blesses you, and you catch a heater and you sell the thing, right? So, we have to be opportunistic in this business. We are willing to stay in something for a very long time. We're working on a thesis right now, that one that we might go into it thinking we might own it 10 or 15 years. So it's a great thing to have that kind of flexibility. But yet, if you look at the history of 33 years and 50 some odd deals, our hold period is about 4.7 years, which is ironically very similar to a fund. And I have no explanation as to why that is. All I can tell you is I guess it just takes 4 to 6 years for these things to typically play out. So we pride ourselves on focusing on doing what's best for the business every day. And if we do that, we by proxy do what's best for the equity. So often we're listening to our management teams in terms of when is the right time to sell. They're the ones they're in the arena every day. They're looking at the opportunities, they're looking at the risks. If we've done our job, they're aligned with us economically. So it's often our management teams looking at us saying, hey, either, maybe we've accomplished a lot of our goals. Maybe some things are going to get harder in the next couple of years. Maybe this is a good time. Or maybe just looking around saying, well, this has been fun, but hey, we're not done here. We kind of want to keep going. Who are we to jump off that train if our management team is executing and they want to stay? So we try to be as flexible as we can in terms of hold period. Other patterns, if you look at the history of TCP over 33 years, the IRRs, the cumulative IRR is almost 40%. It's high 30s. And I think that speaks to the asset class, that these smaller, lower middle market businesses, when you get the right one and you get the right people, they can run on you. So we've had a lot of outsized returns over the years. But look, we've also had bad outcomes. This is the lower middle market. We're buying relatively small businesses. I remind my investors every day, the world burps up $20 and $30 million revenue businesses every day and never stops spinning. So there is volatility in what we do. There's probably more volatility now than there was 30 years ago because the market's efficient. We have to pay more for these businesses than Dan used to pay 30 years ago. And that's okay. Again, the market's efficient. The entrepreneur is now the winner in the transaction. I'd argue 30 years ago, it was the guys with the money. They had all the leverage. Now the founders, the CEOs, the guys who have built these businesses have the most leverage. And that's the way it's supposed to be. They've taken the risk. They've built something of value. So we're having to take more risk now, and that's fine, but it does create more volatility.
So for someone like you, have the conditions for good returns improved because you have a lot of experience, you're better at what you do, you have a stronger identity and a brand? Or would you say they are worse now than they were because of more competition, higher valuations, and a higher cost of capital?
It's a great question, Nicholas. I don't know if I've ever actually thought about it in that context, but as you ask the question, my instinct is to say, I like to think that it's probably the same, but the variables have changed. It is much harder because of competition, because of efficiency. But I also like to think that our experience as individuals and as a team, our scar tissue, candidly, that you build in the bad outcomes. I think we're better. I know I'm better at my job than I was 10 years ago. I'm probably better at it now than I was 6 months ago. You're growing every day as a professional. At least you better be. So I think it's getting more difficult. I think the asset class in terms of private equity, I think that's true, because if you look at the returns over time, they've come down across, I think, every private equity size or asset class. So I do think our world is getting harder. But I do believe you can mitigate that risk through experience, decision-making, discipline. And I would expect that won't change. I think as long as I'm in this business, that's probably going to be true. I think it's going to get harder every day. So it's going to be incumbent upon me and my partners to get better every day.
Within your EBITDA range from 3 to 20 million, would you say smaller deals have a better chance at high returns, or is it the same across the band there?
Yeah, good question. The majority of the deals that TCP has done, will do, or, my sweet spot's 5 to 15. If I did every deal inside that range, that'd be great. 20 is great, but that's not going to happen for guys like us very often. Doing the small deals is hard. There's just more beta. They can run on you. They can get exciting. I would say in my personal history, the companies that have probably performed the best, it wasn't necessarily entry point size. It always comes back down to, do you have the right people in the deal? Did you bet on the right management team? We've had some really small companies take off and be big wins. We've had a couple of pretty decent sized companies, EBITDAs in the teens that have turned into really big wins. And exactly the opposite on both sides as well. Bigger companies that have failed, smaller companies that just never really grew into what they were supposed to. Size helps, scale helps. It's a general barometer of maturity of a business. It's not always true, but I think generally it is. So bigger businesses tend to have better downside cases in my experience. But the upside cases, it's all about the people in them. Did you bet on the right people? Are you economically aligned? Did you add good people? And then ultimately, is everybody rowing in the same direction?
Jason, let's hear about one of your deals. You had shared a little bit with us about it, because it had a great run and then experienced the black swan of COVID and ended up being a loss for TCP. But I think there was a lot of learnings in there about Capex businesses, about timing, so would love to hear kind of that first happy and then second unhappy chapter.
Yeah, I never mind sharing the story. I think if you ask people that know me personally, we kind of an open book, and I tend to talk about my bad experiences more than my good ones, because again, that's where the learning is. We had an asset in our portfolio pre-COVID that was the best, arguably the best company in our portfolio at the time, at least the one that we think was careening towards the best exit. It was in the hospice DME space. We had grown it into a pretty big business, teens of EBITDA. We had a banker signed up to sell it. We were going to go to market. We'd had some interest come in. It motivated us to get it ready. We were putting it together when COVID happened. And, that COVID fundamentally changed the hospice space, which therefore fundamentally changed the hospice DME space. COVID didn't kill our company. We had years after COVID to try to adapt the company to the new market conditions. We failed at that. I failed at that. And it ended up being a loss. We ended up winding the company down in 2024. The writing was on the wall in 23. I had a very unique experience after a CEO left the business. I think after he kind of saw the writing on the wall. I had a unique experience of stepping into the business as the executive for the last 12 months of the company's life. There was some really important work that needed to be done in terms of selling the assets off to our competitors, because there's patients on the other end of that transaction. These are hospice patients that need equipment like oxygen. So it was very important for us to end well, so to speak. There was not much we could do about the outcome, but it was very important to us that we made sure that the assets ended up in places where there was no risk to the patients. We did that successfully. It was a very painful experience and a lot of lessons learned. We all made so many mistakes on that deal, as again, we were unsuccessfully trying to adapt the business to new realities in the marketplace. You mentioned a couple of things that the easy headlines, right? Capex businesses, heavy Capex businesses are hard to run, and they're dangerous because when things turn, when pressure on the cash flow turns, it can turn quickly because the Capex cycle doesn't stop. We grew through acquisition. So we were, we had leverage on the business and the pressure of Capex when things got really hard. And that turned out to be a dangerous situation, and one that became it would have taken too much cash to try to rectify, where we couldn't justify continuing to put more money in the business, especially with what we believed to be, and I think we proved to be right. It turned out to be permanently impaired market conditions in that particular space. Now there are companies that survived. There are a couple, but it consolidated rapidly. Most of the companies ended up with similar fates. The ones that survived had very healthy balance sheets and had very unique regional footprints with a lot less competition. Again, there's always a lot of variables that pick the winners and losers, but that's one that we talk a lot about with our investors. We talk a lot about just internally in terms of things we could have done differently, and it starts with, we should have just sold the business, right? You always think when you had a win and then something changed and you never got it out the door. There were always moments in time where you're looking around the board table saying, have we accomplished enough? And in that situation, it's a pretty obvious yes. You should have sold the business sooner.
How big of a win would it have been if you had gotten out of it at the beginning of 2020?
It was a lot of equity, and I think conservatively, because it wasn't a great business, it was a good business, but there was a lot of interest in that space. It's probably a 3 or 4x deal on a really big amount. It's right where you're supposed to be in these things, and I'm confident we would have achieved that. But life happens. I don't think COVID was on anybody's bingo card. So, and we just failed to adapt. But I don't complain about it a lot though, because we benefit in the end. We benefited through COVID. We were net sellers through COVID. We lost one business years later, but it was because of COVID. We got out of one business that was going to have a lot of trouble through COVID, and we were able to get out of that with 90% of our money very early in COVID when the writing was on the wall. I'm very proud of that transaction because we saw it coming, and we hustled to find a home for business and mitigate a loss. And then we had several software businesses in COVID that were mature. And if you remember in 2019, 2020, 2021, it was having mature SaaS companies was a great place to be. So we had a couple of very big wins during COVID, and we actually got to hand a bunch of proceeds back to our LPs when mostly they were getting capital calls. So COVID was tough on all of us. Ultimately, again, it cost us one, and it was a big one, but we managed through it as a firm, like we always have. Again, 33 years, you go through recessions, you go through unique events. We managed through COVID. We had several big wins through it. And here we are, we're still in business. So, but yeah, that's one I'll talk about for the rest of my career, I'm sure. And hopefully you remember those lessons.
And did it leave any lasting bad taste in your mouth for types of businesses, like Capex heavy businesses?
Yeah, it's interesting in this business. You always ask, people ask, what don't you do? What places do you not invest? And if you ask any private equity group and any professional, that list is usually going to be a pretty linear relationship with things they've had bad experiences in. So right. It would take a pretty special situation for me to want to do a Capex intensive business again. We have essentially left the healthcare market. Now we were already doing that. Dan would tell you he built the brand in post-acute healthcare. He's well known in that space. So that's part of the business that I grew up in. We had already kind of moved on from that, but I think that experience really cemented that in that we did not have direct reimbursement exposure as the equipment business because the hospices were our customer, but they had direct exposure, right? So we were already moving away from government reimbursed healthcare service. That made it very easy to close that door, because even though that was part of the thesis that, hey, we're not billing Medicare, so we have a nexus. But when your customers are feeling that pinch, you're going to feel the pinch, So, there's others again, really being honest and objective about timing and is good enough is really important. Again, I wish I would have sold the business earlier because I could have.
But Jason, was there really something there that you feel like you did wrong? Of course, it's easy to say, it would have been nice to sell before COVID, but that just strikes me as one that's too easy to be self-critical about, because when a business is growing, and it looks like you've still got a lot of runway to continue, why sell then?
I don't want to dodge your question, right? So one of the specific things that I think about often, we grew through acquisition. We probably grew too fast through acquisition. We were still, in hindsight, we were still developing our team there, and we probably let them run too fast. And then again, that causes some of these issues, including the hubris of starting to dream bigger, right? Things are going well, you're adding EBITDA at good value, and you start to think, wow, maybe we can build a really big business. And that gets me back to another core tenet of why I think TCP has survived all these years. I think we think slightly differently than some maybe a lot of independent sponsors. A lot of guys get in the business and want to get 2 or 3 platforms and hold on to them, build them as big as they can, and that's their career. TCP has been built on longevity in transactions. Our job is to create returns for our LPs, no matter whether those are local friends LPs or whether it's a big institution. Our job is to sell businesses once we've accomplished our goals. And we're not supposed to empire build. Now, you may get lucky once or twice in your career and you catch a heater and something grows really big, but that's not our job to try to do those from the beginning. Our job is to set out with an investment thesis that probably shows 3 to 5x returns. That's typically what we're aiming for, is 3x plus returns. And generally speaking, once we've accomplished those goals, unless the risk profile has gotten infinitely more attractive, our job is to transact and to turn that capital over, its velocity of capital, and then let our LPs decide to invest with us in the next one. And I think that's always been part of our philosophy. We're trying to do this for decades, not years. And I think situations specifically like that, where we wish we would have sold earlier, it just further cements that discipline. When I've got a win, take it. And if we do decide to stay longer, it's because maybe things haven't worked out as well, or maybe there are specific reasons why we think it's a good profile. Like, we've got a company right now that we've owned for 6 years, and we're going to keep it for 2 or 3 more years, but it's debt free. We've already paid the equity back. We're taking equity distributions now. So that risk profile has changed dramatically. It's a market leader in what it does, and it has no debt. Okay, yeah, we'll let that one run for a while. But generally speaking, our job is to take wins and to hand those returns back and let our LPs decide what they want to do with that money. Do they want to give some of it back to us? Great, I hope so. But put it back in their pocket. Put it back in our pockets, right? Because we're sitting alongside our LPs with the money we invest, and obviously the promote opportunity underneath it. So,
Jason, it's a bit of a counter to a bit of what you see as a trend now, where long-term hold, patient capital, feel like you see that more and more now in the independent sponsor world. Maybe that's not new. Maybe there's always been that, but we talk to a lot of sponsors here who position themselves that way. And you're actually saying, sure, maybe we'll have some that we hold on longer if the stars align that way. But the point is not long-term. The point is, as you said, velocity of capital. So that's a real stake in the ground.
Yeah, for us it is. And again, there's no right or wrong. There's a lot of ways to skin the cat, so to speak. We look at it as our ability to be patient allows us the opportunity to work out of problems, to let something develop, that hasn't, maybe the thesis just hasn't, something in the market that we were excited about just hasn't happened yet. Maybe our management team has taken longer to mature. Maybe we missed on an executive. That's why the flexibility of staying in something longer matters, right? It doesn't necessarily mean, hey, things have gone well, and now I've got stars in my eyes about the size of the company that I can go build, in the size of the promote that I can build. Now, those things happen sometimes, but we don't believe that should be the core motivation of just keeping something longer. It's all about risk-adjusted returns. And again, unless the risk profile gets improves dramatically, you should probably stick to your thesis. But again, everything, every situation is different. If you have something that has no leverage on it, if you have a great management team and they're banging their hand on the table about specific opportunities that they're going to go tackle, okay. I mean, again, back to that original comment I made earlier, it's often the management teams that are really convincing you whether it's time to sell or not. And if you had a management team that is banging their hand on the table because they're excited about something and you've de-risked the investment, okay, we'll listen. We're always flexible. But if we're not compelled to stay, our job is to return our investors' capital and to go find something new to start over on.
Jason, you mentioned that across so many platforms, you're looking at high 30s, almost 40% IRR. You're looking at an average hold of 4.7 years. You had several wins coming out of COVID because you had mature businesses at the peak of the M&A market. If you contrast your LP communication on those versus the hospice deal that you told us about, how do you roll out bad news? How soon do you tell them, this is not looking good? How do you deal with the lender? How are the dynamics in a situation like this? Because it's easy, right, for an independent sponsor to hope for good news and wait another week, or just don't tell them, omit a little bit of the full truth because this will correct itself soon enough. So how do you play that in reality?
Yeah, it's a good question. We just over communicate. That's who we are. Part of that is just the expectations that we've created. Again, most of our equity investors are friends of ours. We see them all the time. See them at the coffee shop. See them at church. They ask. They call me. They text me. How's this doing? And our biggest capital provider, Plexus, we're about to do our 9th deal with, right? So we talk to our capital providers all the time because we're in other deals with them. So we've just gotten in the habit of over communicating, including when things aren't going swimmingly. We send a quarterly update out to our equity LPs, roughly 60 days after the close of every quarter. It looks exactly the same. It's a 3-4 page deck. It's got the quarterly financials. It's got a couple of pages of commentary. Hey, this is what's going well. Hey, this is what isn't going so well. That's just what we do. That's our process. We've always done it that way. We always will, because again, that's what's expected out of us now. We don't think hiding bad news has a long-term positive effect. If anything, it's actually quite detrimental, because as things are getting harder in a challenge deal, you're having to make rapid decisions. And if your partners, especially your capital partners, aren't fully up to speed on the situation, you can't make fast decisions together when you're getting down to the really tough stuff. So we pride ourselves on communication. And again, back to one of the reasons people give you money after you've just told them you've lost their money. They weren't surprised by it. These are smart people. If they got enough money to give me to invest in guys like me, they've made a lot of money somewhere else, probably owning a business. They're reading my quarterly reports saying, okay, this one's not going very well. So if it ever ends up in a bad situation, if we end up in a capital call, they kind of knew it was coming. And again, that's credibility. At the very least, it's credibility for them to know I'm never going to lie to them. I'm never going to omit information. They can make a decision as whether they want to hold me accountable and not invest in the next one. But they're not going to say that I lied to them. That I'll never allow that to happen.
Did you have any investors for whom this was the only deal they'd invested in you, or hypothetically, if there was one of those, is that just tough luck and hey, you should invest in us next time regardless, or can you alleviate it somehow by helping them out, getting them into another deal, or how would you manage a situation like that?
So the answer to the question is that yes, that always happens. It inevitably, you have a bad outcome. It was always someone's first investment, right? That's just again, 33 years, lots of investors. That's just the math just says that's going to happen. For our local investors that have been with us a very long time, we programmed them to become what we call programmatic investors. Do every deal. Let us build you a portfolio. Don't cherry pick. Don't over allocate in one. Don't under allocate in another. Because look, this is the lower middle market. There's volatility here. So part of the reason our investors have stayed with us so long is because we have helped them stay disciplined about trying to get exposure to everything. Don't cherry pick. And therefore, when you have a bad outcome, the portfolio, the history together will make up for it. Inevitably, because we've grown over the years, because we get introduced to friends of friends, our LP base has turned over decades. Inevitably, you'll have a bad deal where you have a handful of guys that it's the first check they wrote. Maybe it's the only check they wrote with you. I try not to take one check from what I would consider a retail investor, an individual or family office. I tell them, look, if you're going to write one check and you're going to judge me on one outcome 5 years later, I don't know if that's a good relationship for either one of us. Pick a number. If you want to invest in TCP, pick a number and divide it by 3 or 4 and do the next 3 or 4 deals. Then we're going to have a really good shot of hitting our expectations and having a long history together. With the institutional capital, that's different. Those guys are going to come in and out of deals as they deem it, with of interest and or within their investment thesis or not. So you run the risk of an institution being in only one deal with you, and if it's a bad outcome, that's their experience with you. And there's not a lot you can do about mitigating that risk other than, again, over communicating and making sure that everyone in the deal with you knows exactly what's going on and why it's happening. So at least that way, if you have a bad outcome, everyone feels like they've been properly informed. They've had every opportunity to help you if they can. But that's just the business. And when you have a bad outcome and it's the only check someone's ever wrote for you, whether it's an individual writing a $100,000 check or whether it's an institution writing a $50 million check, there's not a lot you can do about that outcome other than just own it and let them make a decision as to how ultimately develop their own perspective as to what went wrong there.
Jason, before we let you go, wanted to do one more segment on succession. So as we said at the top, TCP has now gone through a number of iterations, versions. We're at 4.0. You said you're 47, so you still got a little gas in the tank, I think. But there are now younger guys in the firm below you, and you've been the younger guy, and now you're the partner. And you see yourself as a steward. So you no doubt have thought about what the future looks like in a post-Jason world. How do you think about it for TCP? How do you think about private equity firm, independent sponsor firm succession generally?
Yeah, I think to answer the last question first, succession planning is something that private equity has not done well over the years, in my opinion. And the smaller the group, the harder it is. We've always taken that seriously. We talk about it. My partners and I now, this is something we're not shy about. And we talk to our young guys about it directly every day. And I tell them I'm just as invested in their development as they are because I need them to develop. Yeah, you're right. I'm 47. I got a little bit of gas left, but I think I can run at this pace for another 8 or 10 years. And then I want to be the old guy in the deal. I want to be the gray haired guy that shows up for the board meetings and then leaves. But I can't grow old gracefully, so to speak, unless these guys develop. So we talk about that daily. I think we have a history of developing people in this firm, and not just that are here. I laugh with Dan all the time. I'm a football guy, so I use this reference. Like, Dan is the Bill Parcells of Dallas lower middle market private equity. If you know the Parcells coaching tree, I've got 10 or 11 competitors that were at some point in their career part of TCP. So there's been a lot of talent that has gone through these walls and then gone on to do other things. So we've got 3 guys underneath us right now that we care about, that we have history with. One of them is, we're officially a family business now. Andy's son, Jace, is one of our analysts, and he's great. I've known the guy since he was 15 years old, and so we care about these people, and they're the right people. Now it's our job to develop them and to also continue to create opportunities that allow them to grow and mature and also make money, to make sure they're ready. And then the next evolution is making sure that when they're ready and one of us is ready to start slowing down, that we're also mature about it, in that we have a belief over here that there's not a lot of actual value in these small private equity groups. It's really just the partners, right? So therefore, the economics have to reflect who's doing the work, who's actually doing all the heavy lifting. So as we want to slow down, the economics have to shift to the team that's actually doing all the work. And we've been great about that historically. And I think my partners are very aligned about that right now as we speak, and have a good plan about how the shop is going to evolve. But we have to continue to execute. We have to continue to do good deals. The young guys have to get reps in those deals. And then when it's time for one of us to start, quote unquote, buying our time back, the economics have to shift.
So TCP was started by Dan. So presumably he owned 100% of that entity at one point. So how have the economics legally, contractually evolved over time? And now that you're one of the 3 partners, I assume you have a certain share of that ownership, but you're saying that brand, so to speak, has no value without partners. And the partners who do the work need to own the economics. So how does that shift over time, and how do you kind of have that conversation?
Yeah, it's a good question. One that evolves, right? The conversations we'll have with the next generation were probably different than the ones we had with Dan, and because every partnership's different. It ultimately comes down to who owns the promote, right? If we're really being simple about it, the partners own the majority of it. As a partner wants to work less and contribute less, not just to the portfolio, but also to the day-to-day operation here, he deserves less promote. Let's just be honest. More of that promote opportunity has to flow to the deal teams, the guys shagging the deals and building the external relationships that are bringing more deals in and raising capital. So we think it's actually pretty easy. Every negotiation's unique, but just generally speaking, as you want to do less here, you'll own less of the promote. And if you start with and you agree with that basic philosophy, then it's just a matter of time and expectations of what are expected of you in order to justify your economics.
Is there a formula that you guys apply? And also, with any given deal, it's sometimes hard to predict how time will evolve, right? I mean, you might have a life event in 2.5 years that renders you uninvolved for the second half of an investment. And there are, as you know, the 3 big stages: entry, ups, and exit. And they all require mind share and time investment. So yeah, is there a formula, and how do you account for changes that may appear in the future?
Yeah, there's no real formula. This is just a daily conversation you have with your partners about where you are in life, how things are going, how are the young guys doing, and ultimately you got to triangulate what's fair and what's appropriate with the variables that are on the table at that point in time, which again are different than they were 5 years, 10 years, 20 years ago. In terms of dealing with the unpredictable nature of life, we've just always rolled with the punches, and you deal with the things that come up. It starts with caring for the people you work with every day. I love these guys. This is my family. And if we believe that, and we're all working as hard as we can, trying to help each other and be successful collectively, as things come up in life, you just evolve. And again, you try to do what's best for the partnership. And that means guys leave. Some guys leave to start new things. Some guys retire. Some guys get sick. Life happens. Some guys don't pull their weight. it's no different than any other small business. We're running a small business of 6 here. But if we care about each other and we're all grinding and we're all having more success than failures, this other stuff will figure itself out. I just honestly believe, because it always has. And I believe someday TCP will be a 50-year-old brand. And that's important for me that it is. I want to look back. Like, I'm born and raised here. Dallas is my home. I grew up 45 miles north of Dallas. I went to SMU. My wife's from Southlake. This is home for me. Someday I want to be sitting in a coffee shop and see some of the young guys, TCP guys, sitting at another table doing a deal. Like, I'm romantic that way in terms of kind of how I want this to end, and I want it to be something I'm proud of. And I think it can be. And that's the driving force for all of us now, is to make sure that we give these guys the opportunity to step up and take it the next step after we're too tired to hold the baton anymore.
Well, Jason, that is a good note to end on, I think. Before we let you go, we hope you'll consider Minds Capital for your next deal. We invest equity into independent sponsor-led acquisitions, as you know. So we hope to be on your call list in the future. But we really appreciate your time and you coming and sharing so much about your own philosophy and the philosophy underlying TCP. So thank you very much.
Yeah, thanks for having me. I've really enjoyed it. And by the way, you will be seeing a deal from me. We've got a new one that we're really excited about, and it'll be in Nicholas's inbox this afternoon. So,
perfect.
Hope you're doing well.
Great. Good to hear. Great. Thank you, Jason.
All right. Thank you.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.